Here is your complete YouTube script. Something is shifting in the British property market. And if you own a home, if you are trying to buy one, or if you have a mortgage sitting over your head right now, you need to understand exactly what is happening and why it matters deeply to your financial future. Welcome to UK Property Compass, the channel that cuts through the noise and gives you straight, honest analysis of the UK property market. I'm your host, and today we are covering one of the biggest stories in British economics right now. House prices are slipping, mortgage costs are biting harder than ever, and the Bank of England is holding interest rates at a level that is squeezing millions of households right across the country. This is not a drill. This is the reality of the UK property market in 2025. And today, I am going to break it all down for you, clearly, honestly, and without any jargon. So let's start with the headline that has been making waves. UK house prices have begun to slip. Now, let's be precise here, because language matters in property. We are not talking about a crash. We are not talking about the kind of dramatic collapse that some commentators love to dramatise for clicks and views. What we are seeing is a genuine measurable cooling of the market. Prices in many parts of the country are either falling modestly or stagnating. And when you understand the forces driving this, it becomes very clear that this is not a temporary blip. There are deep structural pressures at work here. Let's go back to the beginning, because to understand where we are today, you have to understand how we got here. Cast your mind back to the years immediately following the pandemic. The UK property market did something that surprised almost everyone. Instead of collapsing, as many feared it would, it exploded. Prices surged. Demand went through the roof, if you will pardon the expression. People were reassessing their lives, moving out of cities, hunting for more space, more garden, more room to breathe. The stamp duty holiday introduced by the government poured rocket fuel onto an already hot market. And through 2020, 2021, and into 2022, house prices in the UK rose at a pace not seen in decades. The average UK house price at its peak touched levels that genuinely shocked people. In some parts of the country, London, the South East, parts of the South West, properties were selling for tens or even hundreds of thousands of pounds above their asking prices. Gazumping came roaring back. Estate agents were reporting queues of buyers for every available property. It felt, to many people, like the music would never stop. But it did stop, and the moment it stopped was the moment the Bank of England began raising interest rates. Now, let's talk about the Bank of England, because it is absolutely central to everything happening in the property market right now. The Bank of England's primary job is to control inflation. When prices across the economy rise too fast, when your weekly shop costs more, when your energy bills spiral, when services become more expensive, the bank uses interest rates as its main tool to bring things back under control. Higher interest rates make borrowing more expensive. When borrowing is more expensive, people spend less. When people spend less, demand falls. And when demand falls, prices, in theory, come back down. Beginning in late 2021 and accelerating through 2022 and 2023, the Bank of England raised its base rate 14 consecutive times. 14 times. It went from a historic low of just 0.1% all the way up to 5.25%. That is a seismic shift in the cost of borrowing, and the effects have rippled through every corner of the British economy, but nowhere more visibly than in the housing market. Think about what that means for someone with a mortgage. A homeowner who took out a 2-year fixed-rate deal in 2020 or 2021, when rates were at rock bottom, was enjoying monthly payments that seemed almost too good to be true. A £250,000 mortgage might have cost them around £800 or £900 a month. When that fixed-rate period ended and they came to remortgage, suddenly they were looking at rates of 5, 6, even 7%. That same mortgage could now cost £1,200, £1,300, even £1,400 a month. For many families, that is an extra £400 or £500 every single month. That money has to come from somewhere, and for a lot of households, it simply doesn't exist. This is the mortgage pressure that is building right across the country, and it is not fully played out yet. Millions of homeowners are still sitting on fixed-rate deals taken out at low rates during the pandemic period. As those deals expire over the coming months and years, more and more families will face the same brutal shock when they come to remortgage. Some analysts estimate that by the end of this period, the average household remortgaging could be paying over £4,000 more per year than they were before. That is an enormous sum, and it is having a very real effect on behaviour. People who might have considered moving house are staying put. Why take on a larger mortgage at today's rates when the monthly payment would be so much higher? First-time buyers, already stretched by high house prices, are finding that even if they can scrape together a deposit, the monthly mortgage payments at current rates are simply unaffordable. And sellers, sensing the shift in the market, are finding that their properties are sitting on the market longer, that they are receiving fewer offers, and that buyers are far less willing to pay over the asking price than they were 2 or 3 years ago. All of this feeds into falling or stagnant house prices. When demand drops and supply stays relatively stable, prices fall. That is basic economics. And right now, demand in the UK property market is being suppressed by one dominant factor above all others: the cost of borrowing. So what has the Bank of England actually done about rates recently? This is the question everyone is asking, and the answer is nuanced. The bank did begin cutting rates in the second half of 2024. The base rate came down from its peak of 5.25%. First to 5%, then with further cautious reductions. And there was genuine hope in the property market that these cuts would accelerate, that mortgage rates would fall meaningfully, and that the market would begin to recover its footing. But the bank has been extremely cautious, and there are good reasons for that caution. Inflation in the UK, while it has fallen significantly from its peak of over 11% in 2022, has proven stubborn. Services inflation in particular, the cost of things like insurance, eating out, haircuts, and professional services, has remained elevated. The bank is acutely aware that if it cuts rates too quickly and inflation reignites, it will face an even harder task bringing it back under control. The memory of the 1970s and early 1980s, when inflation ran rampant and caused enormous economic damage, still haunts the institution. The result is that rates have remained higher for longer than many people hoped. The property market has not received the boost that a rapid series of rate cuts would have delivered. And mortgage lenders, who price their products based on expectations of future interest rates, have been equally cautious. Many of the best mortgage deals available today still carry rates well above what borrowers were enjoying just a few years ago. And until rates fall meaningfully and sustainably, that is unlikely to change dramatically. Now, let's look at what this is doing to different parts of the market, because the picture is not uniform across the UK. London, as always, is its own story. The capital has seen some of the most significant price cooling, particularly in the higher end of the market. Properties valued above £1 million have been sitting unsold for months in some areas. International buyers, who have historically supported the top end of the London market, have been deterred by a combination of high prices, unfavourable exchange rates, and the additional stamp duty surcharge for overseas purchasers. Meanwhile, at the more affordable end of the London market, demand remains strong because supply is so desperately tight, but affordability constraints are biting hard. In the north of England, the picture is somewhat different. Cities like Manchester, Leeds, and Newcastle have seen their property markets hold up relatively well compared to the south. Prices in these cities, while not cheap by historical standards, remain far more accessible relative to average local incomes. And with strong economic activity, good employment, and ongoing investment in infrastructure and regeneration, these markets have retained more buyer interest. But they are not immune to the pressures of high mortgage costs. They are simply feeling them less acutely than the South. Scotland and Wales present their own dynamics. The Scottish property market, operating under its own legal framework with its own purchasing process, has shown resilience in many areas, particularly in cities like Edinburgh and Glasgow, where demand from both buyers and renters remains robust. Wales has seen some cooling after the pandemic-driven surge in demand for rural and coastal properties, with the end of the stamp duty holiday and higher borrowing costs reducing the frenzy that temporarily inflated prices in places like Snowdonia and the Pembrokeshire coast. One group that deserves particular attention in this conversation is first-time buyers. Because for young people trying to get onto the property ladder right now, the situation is genuinely very difficult. House prices, despite their recent cooling, remain at historically elevated levels relative to average incomes. The deposit required to buy even a modest home in many parts of the UK is enormous, often representing years of saving, even for people on decent wages. And then, having finally scraped together that deposit, first-time buyers face monthly mortgage payments that consume a huge proportion of their take-home pay. The government has introduced various schemes over the years to help first-time buyers. Help to Buy, Shared Ownership, the Mortgage Guarantee Scheme. These have helped some people, but critics argue that many of these schemes simply inflate demand without addressing the fundamental issue, which is that the UK does not build enough homes. Housing supply has lagged behind demand for decades. Planning restrictions, local opposition to new developments, land banking by developers, and the sheer complexity of the British planning system have all contributed to a chronic shortage of new homes. And until that supply problem is addressed seriously and at scale, house prices will remain fundamentally elevated relative to incomes, regardless of what happens to interest rates. Which brings us to the question on everyone's lips right now. Where is this market heading? Well, let's look at what the experts are saying. Most mainstream forecasters are not predicting a dramatic crash. The consensus seems to be that prices will continue to drift lower or remain flat in the near term, with the possibility of modest recovery as interest rates gradually fall. The Office for Budget Responsibility, the Bank of England itself, and most of the major high street lenders are forecasting a relatively subdued property market for the next year or two, followed by a gradual return to modest growth as the rate environment improves. But there are risks to that relatively benign scenario. If inflation proves more stubborn than expected, and the Bank of England is forced to keep rates higher for even longer, the squeeze on mortgage holders will intensify. If unemployment begins to rise, and there are early signs of the labour market softening, some households that are already stretched may find themselves unable to meet their mortgage payments. A rise in forced sales could put additional downward pressure on prices. And if global economic conditions deteriorate, whether through geopolitical instability, trade disruptions, or financial market turbulence, the knock-on effects on the UK economy and property market could be significant. On the other hand, if inflation continues to fall and the Bank of England feels confident enough to cut rates more aggressively in 2025 and beyond, mortgage rates could fall meaningfully. That would release a significant amount of pent-up demand that is currently sitting on the sidelines waiting for affordability to improve. There are many potential buyers out there who want to move but are holding off precisely because of current mortgage costs. If those costs come down, they could return to the market fairly quickly, and prices could recover faster than the pessimists expect. So what should you actually do with all of this information? Whether you are a homeowner, a buyer, a seller, or simply someone watching their property's value with concern, what are the practical takeaways from everything I've just shared? If you are a homeowner on a variable rate or approaching the end of a fixed rate deal, please do not leave it to the last minute to remortgage. Speak to a mortgage broker, not just your existing lender, because brokers have access to deals across the entire market and can often find significantly better rates than you would get simply rolling onto your lender's standard variable rate. The standard variable rate is almost always the worst deal in the house. Get professional advice. It could save you hundreds of pounds a month. If you are thinking about selling, be realistic about your pricing. The era of putting a property on at an aspirational price and waiting for a bidding war is largely over in most parts of the country right now. Buyers are cautious. They are doing their sums carefully. An overpriced property will sit on the market and go stale. A realistically priced property will attract genuine interest. Work with an agent who truly knows your local market and price accordingly. If you are thinking about buying, this may actually be a better moment than it appears at first glance. Yes, mortgage rates are high right now, but house prices have softened, which means you may be able to negotiate a better purchase price than you could have 2 or 3 years ago. And if you can secure a purchase now at a more realistic price, you will benefit when rates eventually fall and you come to remortgage onto a cheaper deal. Buy the right property at the right price, not at the top of the market during a frenzy, and you will almost always do well over the long term. And if you are simply watching the market as a homeowner with no immediate plans to move, take a breath. UK house prices have fallen before and recovered. They have always recovered over a long enough time frame. The fundamentals of the UK housing market, chronic undersupply, strong demand, a cultural attachment to home ownership, have not changed. This is a period of adjustment, not a collapse. The UK property market is going through one of its most challenging periods in recent memory. The combination of high mortgage costs, elevated interest rates, squeezed household budgets, and softening prices is creating real difficulty for millions of people. But it is also creating opportunities for those who are informed, prepared, and patient. And that is exactly what this channel is here to help you be. Stay informed, stay calm, and keep your eyes on the compass. If you found this video helpful, please give it a thumbs up and subscribe to UK Property Compass so you never miss an update that could affect your home, your mortgage, or your financial future. Drop your questions and thoughts in the comments below. I genuinely love hearing from you, and I read every single one. See you in the next video.